possible thing that could happen to you on your very first crypto trade is making a massive, unexpected profit.
Oh, man. Yeah, it sounds completely counterintuitive, right?
Right. Like, it makes no sense.
Yeah.
But I mean, if you win big on day one simply by guessing, you haven't actually learned how to trade. You've basically just wired your brain to treat the market like a casino.
Exactly. And, eventually the house always wins.
Always.
Because it creates this deeply ingrained false confidence. You start believing you possess some, innate genius for the markets when, in reality, you just got incredibly lucky on a coin toss.
Yeah, you flipped a coin and thought you were a math project. So, welcome to today's deep dive. Today we are unpacking a really focused source document. It's titled Crypto Trading for Beginners, my exact first trade lesson.
It's a great piece.
It really is. And, even though the title specifically says beginners, the actual mechanics and the psychological frameworks inside this guide are things seasoned veterans constantly need to revisit.
Oh, absolutely. Everyone needs this.
Our mission today is to essentially extract the definitive blueprint for transforming you, the listener, from someone who basically gambles on crypto into a disciplined operator who relies on a proven mathematical system.
Right, because the transition from gambler to systematic trader is entirely about stripping away emotion. You're replacing it with structure. And this guide establishes a fascinating baseline right out of the gate.
Oh, the rule about profit.
Exactly. It explicitly states that the goal of your very first trade is absolutely not to make money.
Which is wild to hear.
Right. The financial outcome is entirely irrelevant at this stage. The sole objective is simply to learn how to execute a systematic plan correctly. The profit is, it's merely a byproduct of a well-executed system.
Okay, let's unpack this because I love this concept.
Yeah.
Think about learning to drive, a high-performance vehicle. Your very first time sitting behind the wheel isn't about entering the Daytona 500.
No, you'd crash immediately.
Exactly. It isn't about pushing the engine to its absolute limits just to see how fast you can take a hairpin turn.
Yeah.
Your first time in the driver's seat is about feeling the tension in the steering wheel, understanding your braking distance, and checking your blind spots.
Just the basics.
You are literally just trying to learn the controls so you don't wrap the car around a telephone pole.
And that structural approach is so crucial. I mean, in a space as notoriously volatile and chaotic as cryptocurrency, this source provides a highly rigid, almost emotionless framework to navigate all that noise.
Yeah.
You aren't trying to win the race on your first day. You are just proving to yourself that you can operate heavy, dangerous machinery safely.
Which brings us to the first crucial step in the author's system. Before we even look at a specific chart setup, before we even talk about buying an asset, we have to understand the macroeconomic weather we're operating in.
Checking the weather, yeah.
Right. You wouldn't plan an Everest expedition without checking the atmospheric conditions. And you definitely shouldn't open a crypto trade without checking the overarching market trend.
And in this specific ecosystem, checking the weather means checking one specific asset, and that's Bitcoin. The text is, it's completely unwavering on this point. You must ask yourself what Bitcoin is doing before you look at literally anything else.
See, and I have to push back on that rule for a second. Because for someone who specifically wants to trade smaller altcoins, like maybe they see huge potential in some tiny emerging project, doesn't obsessing over Bitcoin feel a bit, I don't know, restrictive?
It can feel that way, yeah.
If I'm trading something else entirely, why does the Bitcoin chart dictate my actions?
Well, because Bitcoin effectively acts as the gravitational pull for the entire cryptocurrency market.
It's the sun in the solar system.
Exactly. The guide correctly points out that Bitcoin controls the vast majority of market liquidity and overall sentiment. Basically, if Bitcoin sneezes, the altcoins catch a cold. It's the tide that raises or lowers all the other ships. So, you have to define the primary trend of Bitcoin first to understand the momentum of the broader market.
Yeah, that makes sense. Yeah. And it's actually incredibly refreshing how the author strips away all the complex algorithms here. They force the reader back to the absolute bare bones definition of a trend.
Just keeping it simple.
Super simple. The guide defines a bullish trend simply as higher highs and higher lows.
Yeah.
And a bearish trend is just lower highs and lower lows.
That's it.
It's a fantastic back to basics reminder for veterans who tend to overcomplicate their screens with 20 different moving averages and oscillators. Just look at the basic price action.
And what's fascinating here is the absolute rigidity of the rule that follows. The author states that if you cannot clearly identify that higher high or lower low trend if the chart just looks like a messy sideways heartbeat, You do not trade.
You just stop.
You close the laptop. You literally walk away.
But the psychology of ignoring that market is brutal. I mean, if I'm sitting on the sidelines because the Bitcoin trend is messy, but I'm watching a handful of random altcoins jump 20% on Twitter, the temptation to jump in is overwhelming.
Oh, the FOMO is real.
It's so real. How does the author expect a trader to genuinely shut off that fear of missing out?
Well, it requires a massive shift in perspective regarding what trading actually is. Because recognizing when not to act is the first true test of a professional.
Knowing when to sit on your hands.
Exactly. The market is a continuous flow of data, right? There will always be noise, and there will always be some anomaly pumping somewhere. But if you force a trade when the foundational trend is unclear, you've immediately abandoned your system.
You're back to gambling.
You're totally gambling. The discipline of inaction is what separates the professionals from the tourists. You have to wait for clear skies before starting the expedition.
All right, so let's say we check the weather, and the Bitcoin trend is clear and bullish. We have our higher highs and higher lows. We're officially moving upward.
Perfect conditions.
Right. Now we need to map the specific terrain where the financial action is actually going to happen.
Yeah, we look for the structural framework within that trend, and the guide breaks this down into two critical zones: support and resistance.
Which are essentially the historical floors and ceilings of our chart.
Yes.
Support is defined as the floor.
Yeah.
So the price level where buyers have historically stepped in, realize an asset is undervalued, and push the price back up. And resistance is the ceiling. The level where sellers have historically taken control, deciding the asset is overpriced, and pushing the value back down.
And the text issues a massive bolded warning here.
Oh yeah, it's huge.
It says, avoid buying directly into resistance. It explicitly says to wait for a breakout, or wait for a pullback down to support.
Because buying directly into resistance is the classic trap that devours beginner capital.
It really is.
I tend to visualize resistance like an invisible electric fence. It is incredibly tempting to see a price rocketing upward, printing these massive green candles, getting closer and closer to that ceiling.
You feel like it's going to the moon.
Your brain literally screams that this is the moment. You feel this overwhelming urge to buy right then, because you convince yourself that you are going to catch the massive breakthrough.
Again.
But instead, you touch the fence, you get shocked, the sellers take over, the price plummets, and you are left holding the bag at the absolute top.
And if we connect this to the bigger picture, it really helps understand the mechanism of why those invisible electric fences exist in the first place. Support and resistance aren't just arbitrary mathematical lines drawn by a computer. They are historical, psychological records of human behavior.
They're essentially psychological scars on the chart.
Precisely. Scars. They represent collective human greed, regret, and panic. Think about the mechanics of resistance for a second. When a price hits a ceiling and crashes, a lot of people bought at that exact top.
Right, the people who touch the electric fence.
Exactly. And for months, they hold a losing asset, just watching their portfolio bleed. So when the price finally climbs back up to that original ceiling, those trapped buyers are so relieved to just break even that they aggressively sell everything.
Just to get out.
Just to get out. And that massive influx of selling pressure is what creates the ceiling.
Wow, so when price hits resistance, it's not some magic algorithm pushing it down. It's a literal wall of human regret.
It's pure regret.
It's a bunch of people remembering the pain of the last crash and desperately trying to exit. And conversely, at support, it's the collective memory of missing out. People remember, oh, the last time it was cheap, it bounced massively. I'd better buy this time.
Yeah, and the guide is telling you to respect that localized human psychology. You do not fight the wall of regret at the ceiling. You wait for the market to prove it has enough collective momentum to actually shatter that ceiling, or you wait for it to safely return to the floor.
Which perfectly sets up the actual vehicle you're going to use to navigate this psychological terrain. Because we have the weather, we have the map, and now we get the blueprint.
The fun part.
The author lays out an exact 5-step trade setup designed to completely eliminate guesswork and FOMO.
And it operates as a strict chronological checklist. You cannot move to the next phase until the current one is entirely fulfilled by the market.
Okay, so the sequence starts when the price finally breaks through resistance.
Yeah.
Step 1. The market pushes past that historic ceiling of sellers we just talked about. But the amateur move is buying the second that happens.
Right, don't buy the breakout.
The system forces you to wait for step 2, which is the pullback, to retest the level. The price goes up, but then drops back down to touch the line it just broke.
Which transitions seamlessly into step 3. Old resistance becomes new support. That former ceiling has to prove it can act as a floor.
Here's where it gets really interesting. I like to visualize this entire sequence like moving up through a dilapidated old building.
Okay, I like this.
When you finally break through a weak ceiling to reach the second floor, you don't just immediately sprint across the dark room. That's reckless. That's how you fall right back through the hole you just came up from.
Yeah, you plunge right through.
You stomp on the floorboards right where you are to make sure they can actually hold your weight before you unpack your bags. That retest in steps 2 and 3, that is the market stomping on the floorboards.
It's testing the structural integrity of that new price level. And this raises an important question about the psychology of patience. Because waiting for that pullback in step 2, it is agonizing for anyone tracking a live chart.
Oh, it's pure torture. Everything in your brain is screaming that the rocket is taking off without you.
Because human nature demands instant gratification,
Yeah.
We want to buy the initial breakout because we fear missing the explosive move. But the source material demands confirmation over anticipation.
You don't guess.
You are not anticipating what the market might do based on hope. You are waiting for it to confirm what it has done based on evidence.
Which brings us to step 4. A bullish candle appears. Right there on the newly tested floorboards, you get a visual signal. But let's clarify what that bullish candle actually means mechanically, because it's not just a green box on a screen.
No, mechanically, a bullish candle at a support level means the buyers have physically absorbed all the selling pressure at that specific price and have actively regained control of the momentum.
It's visual proof.
It's undeniable visual proof that the floor is holding under pressure.
And seeing that visual proof changes the whole dynamic. You aren't guessing anymore, which naturally unlocks the final step, entering the trade with actual confidence.
Execution without hesitation because all the conditions have been met.
But, and this is a big but, even with a perfectly confirmed setup, even after you stomped on the floorboards and saw the bullish candle, the market is fundamentally unpredictable. A news event can drop, macroeconomic conditions can shift overnight, and sometimes the floor still caves in.
It happens all the time.
So how does a trader ensure that one bad step doesn't completely wipe out their entire portfolio?
Well, this is where we transition from behavioral charting into pure mathematics. This is the safety net. And the guide is unwavering on this rule. Before entering any trade, you must know your entry, your stop loss, and your target.
Before you even click the buy button, before a single dollar of capital is ever at risk.
Exactly. And the text gives a very clean mathematical example to illustrate this. Let's say your entry price is $100. You set your stop loss at $95.
Okay.
This means if the price drops to $95, the exchange automatically sells your position to prevent further losses. It cuts the cord. And your target, the place where you automatically take your profit, is set at $110.
So this specific setup creates what the author calls a risk-to-reward ratio of 1 to 2. So what does this all mean in simple terms? Basically, you are risking a $5 loss to potentially make a $10 profit. It's like making a bet with a friend, where if you're wrong, you lose a cup of coffee. But if you're right, you win a full lunch. But let's dig deeper into the mechanics of this, because this ratio is the secret engine of trading. Why is the 1 to 2 ratio so magical over the long term?
Because it mathematically insulates you against your own inevitable failures.
I love that phrase.
It's true. With a strict 1 to 2 ratio, you don't even need to be right the majority of the time to be a profitable trader.
Right, really?
Seriously. Let's say you take 10 trades over a month, you lose 6 of them, and you only win 4. You have a terrible 40% win rate. Most people would think a 40% win rate means you're losing money.
Right, because you failed more than half the time.
But let's do the math. Because you strictly lose $5 on the losers, you've lost $30. But because you win $10 on the winners, you've made $40. You are still up $10 overall despite being wrong most of the time.
Wow. So the math protects you from your own inaccuracy. It's a built-in survival mechanism. Along with this mathematical safety net, the guide also mentions using technical indicators for an extra layer of confirmation. It specifically lists 3 in moving average, the RSI, and volume. But instead of just dropping the jargon, let's actually explain how these tools function within the system.
Good idea. Let's start with the moving average. This indicator isn't predicting the future, it's smoothing out the past. By mathematically averaging the price over a set number of days, say the last 50 days, it filters out the chaotic, daily spikes and drops.
It removes the noise.
It gives you a clean, continuous line that shows the true underlying trend. It basically tells you if the broader, long-term momentum is truly supporting your immediate trade thesis.
And then there is the RSI, or Relative Strength Index, which the guide uses to measure momentum. This one is fascinating because it doesn't look at the absolute price itself. It looks at the speed of the price changes.
Yeah, think of the RSI like the speedometer in our car analogy. If the price of Bitcoin is gradually going up, but the RSI indicator is steadily dropping, it tells you a crucial piece of information. The car is still rolling forward, but the driver has taken their foot completely off the gas pedal.
So it's coasting.
Exactly. The momentum is fading, and a reversal or a stall might be imminent. It's an essential warning sign that the surface level price isn't telling the whole story.
Finally, there's volume, which tracks market participation. It basically tells you how many people are actually involved in the current market move. If a price breaks through a resistance ceiling, but the trading volume is incredibly low, it means only a tiny handful of people are buying. It's a hollow move.
It lacks conviction. A low volume breakout is highly likely to be a fake out, pulling you in right before the price collapses back down. And notice the specific phrasing the author uses regarding all of these tools. Human analysis plus indicator confirmation.
Right.
The indicators confirm your structural analysis, they do not dictate it.
They aren't magic crystal balls.
No. Think of them as the dashboard warning lights in our vehicle. They give you critical data, engine temperature, tire pressure, fuel level, which confirms the vehicle is operating smoothly. But the warning lights don't drive the car.
Right, you still have to steer.
They do not replace the human driver who is actively mapping the support and resistance terrain, monitoring the overarching trend, and managing the mathematical risk.
Okay, so the plan is built. The structural analysis is done. The indicators confirm our thesis. The 1 to 2 mathematical safety net is locked in. And we've executed step 5. The trade is officially live.
Here we go.
Now comes what sounds like the ultimate boss fight of this entire process. Managing your own psychology while the market is actively moving your money.
Oh, the mental game. Lesson 6 in the guide lays out some incredibly strict behavioral rules for when capital is actively deployed. First rule, do not stare at every single candle on the 1-minute chart.
Because every little red flicker is going to make your heart skip a beat and just flood your brain with cortisol.
Exactly. You will manufacture panic where there is none. Second rule, do not move your stop loss farther away once the trade is active. And third, follow your predetermined plan.
I have to confess, the temptation to move a stop loss is universally relatable. It is perhaps the hardest urge to fight in all of trading.
It's so hard.
You enter at $100, and over the next few hours, the price dips down to 96. It is getting dangerously close to your hard $95 stop loss. Your brain immediately tries to negotiate with the market.
You start bargaining.
You really do. You think, I'll just drag that stop loss down to $90 just to give it a tiny bit more room to breathe. It'll bounce back. I just know it.
And the exact moment you drag that stop loss down, you have entirely destroyed your risk to reward ratio. You are no longer risking a cup of coffee to win lunch. You are risking a massive steak dinner.
Just to break even.
Exactly. It is a very visceral emotional struggle because humans naturally possess loss aversion. We hate realizing a loss. But we have to strictly reinforce the source material here. The guide demands that you judge yourself by how well you followed your rules, not by the financial outcome of one specific trade.
That is such a fundamental perspective shift for anyone, whether you're a beginner or a veteran.
It changes the entire definition of winning. True success in this phase isn't about capturing profit. Let's say you build your plan flawlessly. You map the support, you wait for the retest, you confirm with the RSI, and you enter at $100.
Okay.
Then, the market unexpectedly turns against you due to a random news event, and you let it hit your stop loss at 95 without touching or moving it. According to the author, that was a highly successful execution of the system.
So you lost $5, but you won the mental game. You proved you could honor the blueprint under extreme psychological pressure.
Yes. You successfully proved that you are no longer a gambler. You operate a sister.
That is incredibly powerful. Let's do a comprehensive recap of this entire journey, because it really is a complete start-to-finish behavioral framework. First, you checked the Bitcoin weather to find the overarching trend.
Right.
If it's clear, you map out your structural terrain by drawing your historical support floors and resistance ceilings. Acknowledging the psychological scars of past traders.
And you deploy aggressive patience. You watch the price break the ceiling and you wait for the retest where the market stomps on the floorboards to prove it can hold new weight.
Right. You wait for your bullish candle confirmation, verify your momentum and participation with indicators like RSI and volume, and only then do you enter, strictly enforcing a 1-to-2 mathematical risk ratio. Entry, stop loss, target.
And finally, once the trade is live, you completely refuse to negotiate with your stop loss.
It is an elegant, disciplined process that removes the chaos from a notoriously chaotic environment. And the author doesn't just want you to listen to theory, they want you to practice the mechanics.
Yeah, the homework section.
Exactly. The guide ends with some exact beginner homework, and we are going to pass that challenge directly on to you. Later today, pull up a daily Bitcoin chart and answer these specific questions. Is the current trend bullish or bearish? Where is the nearest support level? Where is the nearest resistance level?
And based on that specific terrain, what would your entry price be? Where exactly would you put your stop loss? And what would your target be to maintain that 1-to-2 ratio?
Writing those actual numbers down without risking a single dollar of real capital is the perfect way to build muscle memory for the system.
It's logging those crucial practice hours in the driver's seat before ever hitting the highway.
Which leaves us with one final thought to mull over today. We started this deep dive by stating the core premise of the guide. The true goal of your first trade isn't to make a profit. It's simply to prove you have the discipline to stick to a rigid set of rules when things get unpredictable.
Because establishing the behavioral system is always more important than the immediate financial outcome.
Exactly. So, if you can master that framework, what does your ability to honor a strict stop loss in the volatile, highly emotional world of crypto say about your discipline in other unpredictable areas of your life?
Well, that's a great point.
If you can enforce strict boundaries and accept small losses when your money's on the line, where else could a rigid safety net protect you from your own emotions?
That is a question certainly worth exploring.
Until next time, keep mapping those floors and ceilings.